Hey traders, what's going on? Welcome back to another video. So today we are talking about the Fibonacci extension, as you can tell by the title. If you've been paying attention to my Instagram at all, recently I went on one of the best high risk runs that I've been able to perform to date. And I just wanted to go ahead and share this. A few students asked me to go ahead and provide more information on this. So I hope that I can link the other few videos where I've talked about this before already in the course, in the advanced section where we talk about the Fibonacci extension at the 127 and the 161, and looking into take more so wick entries in that area. Ever since recording that till now, I've went on to make some progression to how I go about and use that and understanding the dynamics behind it, why this works, the methodology behind it, and everything like that. So I'm here to basically share how I go about doing this. We'll also back test this, and we'll also talk about market liquidity, which is a very important thing that we must touch on. Yeah, so let's just jump into it. Here we're on odd CAD, no special pair. Ideally, if I just pull out my Fibonacci here, it's better if I just start with the methodology, get understanding the idea behind why this works. So at this point, I can just delete the 50%. We'll talk about the 50% a little bit later. But we have the 127 and the 161. Now, these two here will be used for targets. I believe I may have explained that in the other videos. Now, with this here, we're not using the RSI like we were there. We've just stripped all the indicators, and it's just using the Fibonacci extension, these two zones down here, with the actual market structure and the price and everything like that. And then as we go on to do more development, we'll talk about the liquidity in the market, at the support and resistances, and how to take more sniper entries, like better risk to reward trades. The whole idea behind it, if we go back to the first video, I kind of called this the oh fuck moment. It's the situation in the market where a lot of buyers or sellers may have entered the market and they're looking to actually take a position. Let me just draw this and mark this up. So let's say we have a uptrend that is going about. Yeah, so let's just say we had an uptrend going about, something like this, right? It's progressive in its nature and everything, just like that. Pulls up to this area here, forms our structure, goes up, right? And obviously we expect more higher highs to continue in, probably a retest of this structure, right? And then a rejection up to the upside, making new higher highs. We know there's the situation of double bottoms, which also are bullish indicators, because sometimes the resistance or the support in the case of double bottoms is acting very strong, and so you'll get the same move and higher highs continue. As long as there's not lower lows or resistance acting in heavy effect with double resistances, then price would continue on to its trending direction. Now, there's the idea of these areas down here where a lot of buyers may have gotten in at these areas, understanding the way support and resistance works just like this. And what we would be doing is looking to take a trade from the 127 or 161, which is what we also call the extreme of the market, because this would go out of trend, right? Where we have basically this lineup here. Maybe delete these ones so we can understand a little better. So if we pulled back, went like this, it's now rejecting this one a little before we may get another pullback. But really it just came around to fake out a lot of the buyers, and then continuing off into the main direction. One thing that we have to take in, the reason why we're going about doing it this way, is because we want to have another edge in the market where you know, it's opposed from what everyone else is doing. Everyone else is trying to get in at the support and resistance. And not to say you can't do that. The main thing is always just to gain good risk to rewards on your trades. But this helps to gain better risk to rewards. We explained before that we could take closed candle entries. So any 2 candles that actually close in any sort of rejection at the Fibonacci. Let's do it like this. Right, you would be able to take an entry on something like that, stop loss like this, entry like this, and TP looking to be at the next extreme zone, which is up at the top before it wants to retrace any bit. Now, the other case that was shown in this is that we would just be looking to take our trades exactly at the 127, as long as it went in line with other support and resistance in the zone. So maybe we would have a move just like this. Yeah, so maybe we'll have some structure forming where it creates a double bottom just like this, and it's now back into this area, or yeah, pull down a little bit extra. We'll talk into more about pulling down into an extra area like this, but we'll just have our support and resistance. In this case, support matched up with the 127, looking to take an entry, give a sizable area. We said 30 pips, 35 pips, to take the stop loss, 35 pips to take the stop loss, you know, something tight, something narrow, depending on the time frame that you're working with, and then looking to take the trade onwards. Now, one thing that I'm going to go over, let's just go to the actual market structure, the actual charts, and draw some things in. Let's go to USD, Euro USD. Let's exit this. So let's just have an idea. Let's have a look at how we actually go about placing this, and everything like that. So when I go into the other video on how moving forward with this, I'll go through and explain, yeah, the whole underlying mental belief of this, and how we go about doing it. So generally speaking, let's just say we go on the daily time frame, and let me just mark something up else here. The market is very sporadic, and it does a lot of where we can see the market goes and always pushes to unreasonable places where that result in the loss of a lot of people's money. But still, the major people in the world, the major players in the world, are going on. So it's the same thing as when price goes off into an uptrend, goes down a little more, you know, takes out all those buyers that were in the position there, triggered a little bit of sellers, and then took those sellers' money as it came back up, and then continue off into profit, right? So we're going to look into things like that, and we're just going to track the market. There's the underlying belief that every move that is structured in the market, it's every structure that's made in the market is a vibratory reflection of the potential that it has next. So we're going to look into more of that with the Fibonacci numbers. We'll talk about the meaning behind those numbers a little bit later. But let's just go through and have a look. Let's clear all the drawings. You know, there's those time frames that we're looking to trade on. So depending on your schedule, do you want to trade? Do you want to swing trade? Do you want to take these trades from any time frame? Do you want to take them from the 15 minutes? Because we'll talk about the fractal nature of these as well, that there are trading opportunities that become present on all time frames, and they're the same setup ideas that we're all looking for, the extreme zones, at the areas where a majority of people may have lost their money, and we'll look to take an entry there, because that's the opposite side of the spectrum, where the banks and the major ball players of the market makers, what we call them, are also making their entries. So basically, the way we go about looking at these, we see the trend, right, going up on a higher high spectrum. From this, we know that it's a higher high. From this, we know that we're making higher highs, and higher highs are what's to continue. Not to say the majority is wrong in that case, but they still happen to lose their money. So here we mark off the support and resistance as we normally would. This is something to keep in mind. And as we go down to the lower time frame, we'll basically be looking to take an entry on these areas here, as it has went below the support and resistance, and there's probably a lot of buyers that came into the market here, and as it pushed back down, cleared all of their buying orders. They had the fear of missing out. They had a bunch of things that made them end up losing their money before price actually took off. And especially with this area here, which with the deep red candle, a lot of sellers may have come into the market trying to capitalize on this opportunity and took their money as well. Okay, so we're going to look down into lower time frame. Maybe we might actually get an entry in this area. Maybe this area might be too sharp, but this area will still be a good opportunity if we get a Fibonacci extension down there in that area. So let's go down to the 1 hour. So I've just skipped the 4 hour. The time frame doesn't really matter. We need to get, now for the time frames, we need to get the general perspective. In this case, we know that we had a higher high, so we're looking for price to come back down into this area, this higher time frame extension area, and then we can pinpoint another opportunity, a better opportunity for better risk reward on the lower time frames in these same areas, using more detailed the lower time frame market structure. So if we just look at this and we can see, let me mark this off. Here we have one of the most recent market structure moves from this low to this high, right? So this is just something that we're going to take note of by using the Fibonacci and going down from the bottom, placing it at the top. Okay, and we want our entry at that 127 or the 161, but also in line with this zone and in this support. So as we look at this and we see the 127, the 161 are key areas, we got to remember something, that we're looking to take an entry on the other side of this this block, this support that we're at. The reason we want it on the other side, because we have a lot of traders, like we talked about in the main course of this, that on the rejection of the supports, people would take an entry like this. But in this case, you also got to target good risk to reward ratios on your trade. If this was your low to high, this would never be any good, because you're at a negative win rate. In this case, you're risking 1 to gain 0.6, and that's not something we're looking for. We're looking for risk 1 to gain 1.3 at a minimum. So we talk about this thing. If we look at the videos where we talk about the Telegram pending orders, in this case where we already have set up, we would just edit our next entry, set a pending order to take a trade on a potential reset up at the same area for a better risk reward, because an entry signal has already been produced. The only thing that we would be waiting for is a better risk reward. We know our stop loss goes on the other side of the support, so we take that idea into consideration, that if this were the case for a lot of other traders as well, they would get stopped out and our stop losses would be hit. But our direction is not wrong. But our direction is not wrong. We're just still looking to take an entry from our key areas, and we could take it anywhere on the other side of this zone. Does not have to be exactly here, because there's a few things that we're looking for, which we'll get into more detail when we talk about liquidity. But basically, the liquidity of the market would be right around this area, because of the average setups like this, where we know the big buyers, the big players in the market know that this is the average setup. You probably have a lot of traders that are using their trend lines and stuff just like this, right? Matching low 1, low 2, interacting with this. You get a breakout, activate a bunch of sellers, and then that's a place for them to get in and push the price back upwards. Okay, so we're going to get more into that as we talk about the other things. But nonetheless, this is the way that we go about using it. This is the way, just looking for entries at those areas. And when we do that as well, our stop losses, we're trying to take let's say we took it at the 127, gone a bit early because we want to take it on the other side of the zone, talking about liquidity. We would still get just about 22 pips of drawdown before. So let me talk about the SET, the stop loss entry and take profits, just a little. And it's probably best if I type this. Okay, so I'm just going to type this right here, and then we can just all have a look. So we have the SET, and this is stop loss entry and take profit. So first, stop loss. These have a few criteria that need to be met. The stop loss is definitely going to be at a minimum of 30 pips. That's how I went about it for the week. Right. And we're going to also talk about risk. I'm going to add the risk into. Let me touch about the risk actually first, because that is really important. Okay, so now from the main course, we know that the risk profile that we're doing is 0.01 per $200 in the account. Okay, so we know that's the way we should be going about doing this. And if we were to take it to a medium risk, we would probably do 0.010 with $200 in the account. And I'm going to mark this off as well. Let's say that's medium. And let's say that's low. And then we would set the next one. Sorry, we're going to set this to medium. And then this is high risk, because this is essentially what we were doing as we did this run. Okay, so you got to understand the risk profile to your account. Which one do you want to go about doing? If you go about the high risk, you got to understand this is going to be very emotional if you're not used to this. And you're going to have a lot of ups and downs if you're not taking the right trades, if you're getting scared out of trades, if you are, doing all the negative things that we talked about in the psychological fears, and not understanding that there's still a probable approach to these trades. Trades still will lose, but you need to be able to cut your losses short. Now, here we have basically the risk profile. Let me add profile so you can understand that there's different takes on how you would go about risking in the market. And then stop loss set at a minimum of 30, and they must be on the other side of the zone. Okay, so, and that is going to be S or R. So you got to make sure your stop loss is on the side of the zone. Just like anything we talked about in the main course or taking any type of entries, the best thing to do is always putting your stop loss on the other side, because the other sides have not been reached, and it's out of distance, out of range. It's place that has not been touched. If price is often going through a place, that place is likely to be touched again. So here we can just look at, we know our stop loss. Let's just type in our entries real quick. Entries. When using this method, and actually how I was going about doing this in the last 2 weeks, last 2 or 3 weeks or so, the trades are taken after interaction with the 127 / or, right? Let me add or 121%. So as long as we interacted with those areas, plus with S&R. So we also have to be, the 127 also had to be in conjunction with, in confluence, when we talked about the confluence video with the moving average, the trend lines, the Fibonacci. Same thing goes here. We're using the Fibonacci extension with the 127 and the 161, and pairing that with the support and resistance just in market structure in the candlesticks. Okay, so those are basically where those have to be traded. And when we look at the progress and how we're looking to advance on this actual method, we know that we're going to try to take our trades just a little bit below, just like the liquidity that we talked about, on the other side of these actual support and resistance zones, because we have a lot of what we would call smart money, the tricksters of the market, the ones who are going to set a lot of people up to take their money before continuing and to make their own. Okay, so this is where we're looking to basically place our entries after the interaction has happened with the 127 or 161%, or the support, and with support and resistance. One thing that I'm going to show you guys right now, so you can just copy this, just pause the video. These are basically the settings for the Fibonacci. So I have 0, 1 to cover the low and the high, and then 127 and 161 to cover the extension areas, negative 0.27 to cover the high, and negative 0.61 to cover the other TP area, the other liquidity zone area that is being formed up in these places. So let's talk about our take profit, and that's going on with the 120, with the 27 and the 61. So if we look into our TP, TPs are going to be in multiple places. So the way I go about doing this, if plus 30 pips, then cover. So we're going to move our position to break even at this point. Okay, so we move our position to break even. And then we also have the other cases where our first TP is negative 27, right there at the top, the first area right there. And second TP. Now that's how this works. Now, when I was going about doing this, one thing is once we actually hit 30 pips in profit, I'm more likely to just move my stop loss into break even, or just cover a few pips, or just take my entry all at that, because I'm trading high risk. So making 10 pips on a trade is actually really good. It's going to cover just about 10% of my account, which is something I'm happy with for the day. Keeping in mind, keeping my perspective in check, that a lot of traders do not pull that. So if I'm were to make that amount of money, let me add notes / tips. Have a withdrawing method. Have a withdrawal method, right? So let's say you were to make 15% of $1,000, which is going to be $150. Now let's withdraw 5% of that. So, as you make some money, withdraw some, because you got to understand that you're still making money in the market. Never get caught up just trading and never actually taking out any of your profits when you do start making profits. Now, because of that, I'm going to add in here as well something I've mentioned in the other ones, that close position when you're happy. So if you're up 50 pips and that's what you want, that's what you like the profits, or maybe you have a profit goal that you want to be met for the day. And remember, I used to have one when I just left my job. So close your position when you're happy, when you're satisfied with the way things have gone. Okay, so real quick, I'm going to just go through and jump on another pair. I want to give you another quick real example. Looking at the market, maybe I'll just go through one and mark it up. I know there were some good ones on pound JPY as I traded this week. Let's go. Okay, so here we can start off, let's say, on the daily time. If we start on the weekly, it's going to be a lot. But you can see we've been on a very strong up run. Let's pop to the daily. Same, we're getting some market structure here. More so what I was looking for earlier was this down candle, which would probably get better market structure on the 4 hour. Okay, great. So looking at this, we have this area of a hiccup in the market where we can look to make some moves. There's some support and some resistance in this area with the tight bottom and the tight top. So keeping in mind that the pressure is overall still bullish. I'm looking for the market structure on the lower time frame to actually be able to pop anywhere below this area. I can update this like this. Pop below this area to take a trade to the upside, looking for that 127 rejection or the 161. Let's go here to the top. And we have a perfect pull down right here to meet in line with the previous support and resistance down below. Now, the one thing, like I mentioned in the first videos as well, these Fibonacci's have to be placed on the exact move. So in this case here, where we have the market structure basically pulling down and having a little vibration up before continuing up, all of these are in itself smaller fractals that can be analyzed on lower time frames. On all time frames, we'll be able to look as we go on to the moving on to be able to explain the deep psychology behind the moves that are happening with the liquidity, the liquidity and the basically the setups that the higher institutions are making on the markets before their moves. And I go into explain how basically these highs get broken out and then they go through, form a little setup before actually taking off to a higher degree. Now, here we have other setups where we can see based on all the vibrations, all the what we would just call legs in the market. You have up legs and you have down legs. The Fibonacci is always being respected to a degree on all the time frames. Okay, so these are the areas that we're looking for just to take a trade. And then we would match this up with some support and resistance in the area. Like here we have this line. And here we also have this one. And so on. So here is another type of play, but this one is counter trend, right? If we go from the high to the low, here we do pull up to the 127 before shooting back down, and then we pull down to this 127. So this is a very good thing to use. There's some other students that use this as well, and they seem to love it. It's not something that I've been with a lot recently. I was more so just focusing on using the analysis from the Telegram videos where we're going with the weekly 4-hour and trading in that direction, getting good risk rewards and everything like this. But this is where we can take entries at these actual zones to go off into the main direction, keeping our stop losses really tight and being able to take pending orders on these trades as well. Can I go to another chart and do more? Yeah, so let's just have this 1 hour. If we take a big zoom out, we can see that our overall trend is already going up. If we look to go into this direction, considering the highs and lows, we get to the T pullbacks to these areas to actually take a trade. Okay, 127 here. This one meets up with previous support and resistance. Okay, previous support and resistance, taking into mind the liquidity in the market. You have average wick close in this area, and there's a lot of respect with the candlesticks. If you want to take a later entry waiting for the candlestick rejection, buyers do confirm themselves and come into the market at this area before pushing higher. And we'll look to see that these are on all time frames. So if we wanted to, let's do this right now actually, pop down to, drop to the 15 minutes. To basically see that we're always going to have these maneuvers on every time frame. Is the time frame that we would like to trade with, the time frame that works best with us. If you don't have a lot of patience, you may be more of a scalper. If you don't like that high frequency trading of a scalper. You may like to swing trade if you're busy, or you just like to just live your life. You may just, trade momentarily, intraday some days. You have to define it to your trading plan. And then for this, you can go back to the trading plan video, or just hit me up and send me a message so we can talk about how to get yourself a trading plan that you can wrap around something that you like. Now, this is one thing that I like as well, because we're taking pending orders with this, and we're still taking trades in the main direction and everything like this, and we can capture more moves of the market. So let's pop to another pair real quick. Let's go to this one. Cool. And let's just go ahead and mark this up. Well, basically, we can see the way we have this marked up. This would be a complete markup where we have a support and resistance. We measured this move here, and we're pulling down into this area. The reason this area is actually a key area is because we're looking at the 50%, which was present in the beginning of this video, where we talked about there's some key significance to the 50% area. We'll go on to explain that we have the most bit of density to this area, the most vibrations, the most it's the attraction point, the 50%. So as we identify this area from the higher time frame, go on to the lower time frame, looking for the structure, the median with the 127 at this area. We're looking to basically take that trade. Stop loss is going to be on the opposite side of this zone, and TP is going to be the here I can mark it up for you. Is going to be the 127 and 161. The 127 and negative 27 mix. So there's the 127. Let me make that a little better. There's the 127. And then if we measure this, I don't think this is the 50%. 50% of this move. I'm going to watch this. Right, so we still have room to come up into this area. Let's see if there's any. Yeah. So let me clear this. Let me drop down to lower time frame, and let's just look at the more minor details, see how these are present in the market, to give you ideas basically on how to draw them. Take the structure and you move it across. Now, sometimes you will not get entries, just like these cases here. If you're looking to take an entry on the 127 mixed in with the support and resistance, your stop loss would just get hit, and we get a lot of consolidation down in this area. You may have to update your Fibonacci to better accommodate more support and resistance, just to keep aware of the legs and the extension of the legs, because if we keep in mind that all these moves are happening on a lot of time frames, sometimes you might have, let's say, a 1 minute zone that just gets completely blown out, no rejection, just like this case here, where price completely fell back, and it was a 127. It should have been a 127 rejection there. There was no respect. Price just went straight down. Now, with more knowledge, comparing more of the size of the actual leg, going to basically in higher time frame, because we're considering more candles, more information, we see that this area is actually an influential area as well, and it meets in support and resistance, and we got the liquidity grab there at the bottom, forming more entry possibilities and everything like that. Okay, so the next few videos that we're going to touch into, we're going to actually go through and backtest this some more to see where the entries that we're going to look at. We're going to basically take about a 10 or 20 trade move and basically see how we can update these trades, how we can take these trades and everything like that. And then we should talk about liquidity and how we're actually going to move on with this. So thank you guys for tuning in. Make sure you practice the Fibonacci. This is how I go about using it for the high risk trading. I've also done it on low risk, but it's still basically the same. The risk difference doesn't really, the risk profile doesn't really make much of a difference. Yes, it does to the survival of the account, but not to the procedure of the method. You would still just be taking trades at the 127 and everything like that. We